wasn't a stream of emails last night, was there? It was just the ones we've had from you.
Not sure, I'll check after I start.
Yeah.
Well, good morning, everybody. Welcome to this annual plan workshop. We're just waiting for a couple of people to arrive, but in the meantime, we're going to start our presentation with a bit of a recap of where we've got to up until now. I'd like to welcome Mark de Haast, Jing Zhu, is that how you say it? And Paula Reardon, who are going to be presenting to us this morning. And looking forward to giving some clear steers to council staff, where some of us were a little bit unsure where we got to at the end of the last workshop. So I'll take some time at the end of this workshop just to make sure that we're all on the same page and staff have a clear steer of where we want to head as we move through this process. So I'll pass over now to Mark.
Thank you, Madam Chair. Good morning, everybody. So look, we've also got GMs in the room, and we've got my manager of corporate planning reporting, Cheryl Gavin, and our two corporate planning reporting seniors at the back. So hopefully, between all of us, we can answer your questions. Just to confirm, we haven't received any questions or queries from anyone when we sent the pack out. So I think it's a relatively large presentation to step you through today. I think we've got until midday, and I think probably the same rules should apply as the last workshop, which I think worked relatively well. I think it's easy to take your questions as we go. Please just indicate that you want to ask a question through your microphone. But if your questions relate to, you do have the presentations. If your questions relate to slides that we aren't talking about, I will actually ask that you hold until we actually get to that point. So if we could have questions on the material that we're actually discussing, would be helpful, and we'll be happy to answer those questions. We'll tag team today, so you won't just be sitting hearing from me. You'll hear from the team, and we'll get through this workshop. So the purpose of today's workshop, so I'll try not just read the slides back at you, but we really want to just briefly recap what we discussed at workshop 1 of the 16th of February. There was a lot of information there, so we just want to make sure that the fundamentals of that workshop are front of mind. Then at that workshop, we actually did get some information requests from the table, so we actually want to report back to you on that. Then it is the 16th of March, so time is marching on, no pun intended. But we really need to really. The slide says confirm the rates increase. So it's a workshop, so you can't make decisions. But we really need to know your level of comfort. We're sitting at 8.1%. We really need to know what is the collective thoughts around the table. How do you feel about that? And so it's either to confirm that or to set very clear direction, because we do actually need to adopt an annual plan on or before the 30th of June. Then I'm going to hand over to Paula. So fees and charges sets out all our fees and charges. So anything that's non-rates, as you know from workshop number 1, what we typically do is we inflate all our fees and charges by the local government cost index, but there are exceptions to that. Some of our fees and charges, sometimes we get new fees and charges, sometimes we take fees and charges off, and sometimes the cost increase doesn't go up by inflation because it's set by legislation, and sometimes we need to increase higher than inflation. So Paula's going to talk you through the exceptions. So what are the fees and charges that aren't going up by inflation? She'll explain why, and we can have a discussion. So fees and charges, as you know, the higher you make fees and charges, the lower your rates need to be. The lower you make your fees and charges, then you have to compensate and increase your rate. So it is a balancing act. And the reason why it's a focus for this workshop is because of our dog registrations. What we do is we do seek your approval of our fees and charges, and we get you to actually adopt those fees and charges in May, so that we can tell the community what the new fees are, particularly around dog registration. So there's no surprise. So it's just an added. It's a good service that we give our community. Then what we'll do is we'll just touch really briefly on what the information campaign will be. So at this stage, we've indicated to you that we aren't going to be doing a formal consultation process. We'll be informing the community of where we're at, what we're planning to do, how we've got down to 8.1. So we'll be using the same channels as we did for the current annual plan. So it's not the detailed information campaign, more just how we're proposing we communicate and engage with the community, and then we'll clarify the next steps. So that's the order of business for today, for this morning. Okay. So just to recap, so at this stage, we're absolutely planning on we're proposing that you stick to year 3 of the long-term plan. So no change to levels of service or strategic outcomes. The environment has changed, as you know. So the long-term plan was pretty much adopted before 1 July 2021. A lot of the thinking, a lot of the budgeting was done in 2020. So it is a little bit out of date, and the environment has changed significantly since then, particularly our economy. Supply constraints, excess demand and high inflation have driven up both asset. We know that costs have increased for those reasons. It's impacted on everything. In particular, it has impacted on our capital works program costs. It's also costs us far more to maintain our assets, and our operating expenses are way above what we had anticipated they would be back in 2020. So with our asset revaluation, so we have a really comprehensive asset revaluation program, and what we have reported in the past is that all these cost increases are increasing the replacement costs of our assets. And when we do a revaluation, we reset to what's called the optimised depreciated replacement cost, which means that we've got far more depreciation hitting the ledger than what we'd anticipated. And depreciation is a fundamental building block when we look at how much rates do we need. We still remain at, depending on who you talk to at the moment, some say it's cooling off and some say no ways. But we are still in a competitive labour market, particularly with Wellington, with central government. There's strong demand from Wellington. There are still lots of roles in Wellington, and we're competing against that. So it does continue to make both recruitment of staff and retaining really good staff challenging, because we've got that push-pull. Just in terms of not giving you a huge economic update today, but short-term interest rates are continuing to go up. We know that the Reserve Bank is just, as anticipated. They said they were going to increase rates in February, and they did. So our OCR is sitting at 4.75, and is expected to be, depending on which economist you follow, it's expected to hit about 5.5%, possibly more. Cyclone Gabrielle has turned almost everything on its head, so there's a bit of uncertainty. But the reason why the Reserve Bank increased the interest rates is to try and still get inflation down. So we're still expecting supply constraints, resource constraints. We're expecting all resources to be going up north, which is going to impact on our ability, our capacity to do work, but it's going to drive costs up for sure. So anyway, so interest rates are going up. Those are short-term interest rates. It does impact on us. We have a comprehensive treasury management process in place. We have what we call fixed swaps. 75% of our debt book, of our loan book, is fixed by way of swaps. But that component that is sitting on floating is obviously susceptible to higher interest rates. This isn't a session today on our treasury management, but our treasury advisors are still telling us that that swaps on the open market today are overpriced. They aren't sustainable, which is why we aren't fixing more of that 25%. Because we're wanting the long-term interest rates to come down, and so we're holding. But every time the OCR goes up, it's costing us more money, and that's the reality of that. Inflation has gone up. We're sitting at 7.2%. I do remember sitting before this table just before Christmas saying it was doom and gloom and the recession was coming at middle of the year. And, the economy was starting to retract, and then the day after that, the GDP came out, and actually it showed growth. And Kapiti is actually faring relatively well. So, but you have to look at both macro and micro. But, the reality is, inflation is still at the 7.2%, and the pressure on households is still high. Some households is very high. We are expecting things to, some people are saying that we've hit the peak, and that as the OCR, as the Reserve Bank continues to increase interest rates, things will start to, it's all about actually taking out or eliminating household consumable income. So if that's not happening, that should drive down inflation, people stop spending. And also the other tool that the Reserve Bank is doing is actually forcing rising unemployment. So if people are out of work, they generally aren't spending money. So anyways, those are the two things. Nothing's changed. Interest rates are going up. We're actually seeing probably more globally. If you look at the headline news, there's extreme layoffs happening. We learnt yesterday Meta. We've heard Xero. So it is happening. So we're waiting for those new statistics, but. Economists are certainly saying, look overseas, what's happening. There is actually large-scale job cuts. So inflation overseas is far higher than 7.2%. So sooner or later, that's going to impact on New Zealand. So the challenges on the economy for New Zealand are still there. Cyclone Gabrielle has possibly shifted. But reading yesterday in the newspaper, and I'm certainly not an economist, but there was an article yesterday about what we were expecting as the construction sector to start to go, and you can see if you're reading in the papers, it's certainly the smaller scale construction sector is taking a hit already because of the increased costs of materials. So I really talked about that it's really just, we just need to be aware. We need to be aware that the economy is probably not going in the direction that we would like. And the Three Waters reform. So I'm sure we've all got a view at the moment. The Three Waters reform has been mandated, and it's meant to take effect, assets transferred on 1 July 2024. So our assumption is that holds for now. We talked about inflation at the last workshop, and we talked to you. So typically, what we do is in the local government sector, we all rely on an independent organisation called Burl, who provide a report in September every year, showing what the actual inflation indices are for our specific baskets of goods. So CPI is your common supermarket items or household items. But in local government, we've got different baskets. We've got fuel, we've got asphalt. So we've got a basket for roading, for planning and regulation, the Three Waters. It's just different. It's different baskets. And so Burl actually compile all that information on behalf of the sector, and they release a report saying what the LGCI is currently and what they forecast it to be, which we all use for LTP projections, annual plan projections, etc., etc. So this slide just took you through what we do is we do inflate our budgets. So we know that inflation is there. It's a genuine and real cost increase, and some of our contracts actually provide for inflationary increases year on year. But that slide just set out what inflation we're actually using. So and it actually set out, importantly, it set out the differences. So you can see kind of the assumptions when we set the LTP, and these were based on Burl and what their forecasts were, and you can just see what an impact the changes in the economy have had. So they thought, back in 2020, they thought that inflation for roading would be 3%. They've revised that to 5.1, and we've put 5.1 through our system. So the draft budget has got 5.1, and it just shows the dollar impact and the impact that that's having on rates. And we sort of go through the various areas there. You can see that the LGCI, so LGCI is basically the catch-all the catch-all local government cost index. So there's a specific one for roading, but if there isn't a specific one, it's the catch-all LGCI. And the big one that we talked about really was staff. So we had budgeted for a 1.5% increase to personnel. Bill came out at 2.6. What we've put through our numbers is 3%. So that's the only exception on that slide, is we've actually gone higher than what Bill has advised. And the reasons for that is, again, it's that competitive employment market from Wellington. We are some of our recruitment at the moment, we're onboarding at higher, we're having to pay more than what we plan to pay to get the right people in those roles. And we've had a REM increase, on a platform. We certainly didn't think inflation was going to be at 7.2% for the last REM increase. So we've paid nothing close. The staff increases have been nowhere near 7.2%, but we've actually had to pay a bit more than what we thought. So, of course, there's pressure on our personnel budgets.
So can we just pause there for a second on that slide? I just wasn't sure what LGCI for revenue meant, and it's a negative rates impact, but the 4.2% is a positive figure. Could you just take me through that?
Yeah,
line,
sure.
please?
And I might need the team to help me. But LGCI for revenue, so our fees and charges will go up by LGCI. So that's the default position. That's been the position that this council has always held. So we always increase fees and charges, which is revenue, by 4.2%. So because our fees and charges is going up, so means that our reliance on rates is going down. So effectively, that is what it does is it reduces the rates. And so that's why it's a negative.
Yeah, that's clear. So there's a line there to do with staff. Is now a good time to talk about that? Because I know you said at the start you hadn't had any specific questions, but there has been a little bit of discussion around achieving some efficiencies, as there always is through the annual plan process, and whether we can achieve those efficiencies without making changes to service levels or strategic outcomes.
Yeah, thank you, Madam Chair. Look, if it's okay, this is really just recapping what we did, and then when we get to what is the position, there is a slide on staff level updates, and I think it would be more appropriate that we discuss it then.
Sounds good.
So just continuing the recap, we talked about depreciation. So what this slide really showed you was, so depreciation is one of those fundamental building blocks when looking at how much rates revenue we need. And what we stepped you through was that the big things is that we know that so right now we've got a capital works program that's running for 22-23, and when we build assets or renew assets, the depreciation kicks in the following year. So everything we do this year will have a depreciation impact next year if it's in use. And so we have an increase in depreciation of the Three Waters of $441,000. So that's the Three Waters network. So that's water, stormwater, and wastewater. So right now, in terms of what we're forecasting to complete this financial year, will increase our depreciation on the Three Waters network by $441,000, and all the other capital works that we're doing, that's going to result in additional depreciation of $1.6 million. So there's an impact of $2 million that's hitting the depreciation charge next year. We spoke to you about the 2023 roading reval. So for 30 June 2022, we had done what's called a desktop revaluation. So in terms of the bean counters and our auditors, we're actually required by legislation to make sure that the value of our assets on our balance sheet reflects fair value. And we are slowly getting to a point, because of the increase in unit rates, auditors are actually only really really accepting that accepting third-party confirmation of what our values are. So, in other words, we have to say to our auditors, how have we satisfied ourselves that our assets best reflect fair value? And we are slowly having to always actually go to our valuers. So we are starting to get to a point where we are doing revaluations across all our significant assets year on year. So, but what we agreed with audit for the last financial year is that because we had done a comprehensive roading revaluation for June 2021, for June 2022, we did a desktop review, which means we went to our valuers and we said, look, can you tell us, what's been the increase in the unit rates for roading? And they gave us an independent analysis, and that equated to an uplift, which we booked on the balance sheet only. And so what we're expecting, so for June 2023, we're doing a comprehensive revaluation of the roading assets, and we're expecting that's going to result with everything going, with the unit rates going through the roof. We're expecting we're going to have an additional $1.4 million hit to depreciation on roading because everything is going up. And then our vested assets, so when we have Old State Highway 1 and Peka Peka to Otaki, when assets are vested to us, it's recorded as revenue, but we then take ownership of those roading assets, and we have to maintain them. So they're recorded as an asset in our books, and that's going to increase our depreciation by 158. So all in all, we think that our depreciation is going to be just over $29 million for next year. So and that is a that is a building that is a key building block for determining our rates revenue.
Can I pose a question on that, Mark, or do you want questions
Sure,
at the end of this?
yep.
With regards to our three waters, if we're going down the track of assuming that this is all going to get transferred, because we have to, why can we not take out all the depreciation in relation to three waters as such? Because fundamentally, once those assets go, we're not going to be replacing them. So why make the allowance now for that?
Or through you, Madam Chair. So I'm flanked by Sean, so Sean can help as well. So look, one of our recommendations and how we've actually got the rates down to 8.1% is what we've put on the table is that 441 don't fund that through rates because those assets are being transferred. Our position has been that you have got planned maintenance and you've got planned work on our three waters networks this year that you keep doing. So that when those assets go across, they're in the best condition that they can be. So, but the 441, the uplift, we're actually saying don't. So increase the non-rates funded depreciation by 441 because those assets are going through. There's a risk to that, but we actually have put on the table that we actually recommend that you don't rates fund that increase.
Yeah.
I think what we're trying to do is strike a balance between being aware that the assets might be transferred, so reducing that funding at a certain amount, but also fulfilling our responsibility as the current owners of those assets by continuing with our planned maintenance and works. We don't want to kind of fall into the same trap as a previous council did where amalgamation was on the table and they spent most of the contingency fund in anticipation of that, and then it ended up not happening. So I think I feel like we've got to quite a good balance, but I'm just going to ask, will there be another slide on this separately later, or is now a good time just to cover this off?
Probably now's a good time to cover it off.
Yeah.
So I get that, and I think that's fair and reasonable as an answer. I have no issue around that at all. I guess that the underlying issue I have with that is with regards to the reform and local government reform. Is there's going to be potential, again, this is the unfortunate aspect of all this really, isn't it? It's the uncertainty aspect of it, because I know there's some concern. I know, Mark, one of the suggestions you made with regards to lowering the gap was to borrow some funding on CapEx around that, which is not something we would normally do. And part of my reasons I was okay with that was because of all this uncertainty. So it's just a strange time, you know, if you like. So we do some things that we don't normally do, as such. My concern's always been, and even in relation to that the equation, if you like, say how we're going to do this in maybe 2 years' time, is going to be vastly different from what we're looking at here now. And just aware of the housing, you know, the pressures on our households around the place at the moment. I'm looking at ways to just get that number down further. But I know I'm in the minority with regards to that view as well. So that's cool. That's a fair explanation. Yeah, it's a bit of a shame we just can't do that. But I like what you're saying.
I think we've
Well,
done a
could-
certain amount of that.
Yeah, I was just going to add, so at the moment we're negotiating, having a conversation with DIA about how much debt they will fund as part of this process and the transfer. And non-funded depreciation is an area they're looking at, and it's an issue for a lot of other councils as well, in terms of, I guess, council's view is that that forms part of the debt payment that they're looking to, we're looking to seek from them up till now. So making a significant step change and not funding any depreciation in the Three Waters this year and next year
Undermines.
could, DIA might look at that in a negative context around what they will agree to pay in terms of total debt. So
That's a fair
there's a bit of a
comment.
balance around, yes, this is continuing, I guess, what we've done historically, but I think if you went a lot further and didn't fund any of that, then they
That
might
sort of
have a closer
undermines
look.
our argument with regards to that, adding that in, because yeah, that's a very good point. We have, I guess that's part of that conversation as well. We looked after things well in this space. The other councils haven't, and we shouldn't be disadvantaged because of that. So that's nice that conversation goes. It's good to hear that.
Yeah, because if the rest of the country started to, you know, Kapiti's not huge in terms of what we depreciate and the value of our assets, but again, if everybody stopped funding depreciation in the Three Waters for the next 2 years, then that number the government are currently looking at would be significantly a lot larger. So yeah, it's a bit of a balance at the moment, trying to optimise as much as we can to get paid back in terms of debt,
Okay.
without looking too obvious in terms of everything else that's going on in that space as well.
Cool. Thank you.
I think it was really useful to dig a little bit into that, so thanks for that question.
So, through you, Madam Chair. So before we leave that slide, so you can see the total uplift to depreciation for next year's annual plan is 3.3 million. So, you know, quite often we'll have a conversation with some members of the community will say, you know, why do you need to increase your rates? You know, hold them, but without doing anything, you have these uncontrollable costs coming through. And if you didn't increase your rates, you'd be increasing your borrowings. Increase your borrowings, you're paying interest costs. So, so this is just one of those cost pressures that'll hit us year on year without doing anything, because we've gone and actually built assets. So we talked a bit about operational costs. So there was a waterfall chart, and we told you what are all the cost increases, what are the drivers of the rates revenue going up, and one of them was additional costs. There was operational costs. We themed those. There were costs relating to responding to growth, sustainability and resilience, community partnerships. So that totaled 2.375. That included additional staff, and so we can. So we talked about that. So we've got interest costs. High interest costs are hitting us. High depreciation costs are hitting us. We've got other operational costs are hitting us as well without doing anything, because we're required to do more, and so we need the budget to be able to do that. So that had an increase on the rates number by 2.8%. So in the 16th of February, where we got to, so the opening position where we started with you was we were sitting at an average rates increase of 12.4%. And then we had a discussion about some options to get that down. And those options were, number one, the 23-24 depreciation uplift on the Three Waters of 441, which Councillor Halliday has just pointed out. So we put that on the table. We said, don't put that burden on the ratepayers next year when those assets are going to be going across. And the other option that we put on the table was to reallocate some tranche one better off funding that was assigned to CapEx, actually reassign that to OpEx, which would reduce the rates of $3.1 million. And if we did those two steps, that would take the average rates increase from 12.4 down to 8.1. So there was certainly at the workshop, there was comfort around the table to do both of those options. And so that's what we've put through our system so far. So this is just a lovely little chart telling you the journey that we've walked together so far. So, so the long-term plan has provided for an average rates increase in year 3 of 7.9%. That's the bar on the far left. We had a chat with the council on the 13th of December, and our cost pressures had meant that we haven't had it. We're indicating an average rates increase of 14%. That's a normal process where we bring back to the table what are the cost pressures that aren't in our budgets, and it looked at 14%. We closed for Christmas. We came back, a couple of things had changed. That 14% had dropped down to 12.4%. Most of that change was due to depreciation came down because we're now forecasting we obviously aren't going to do the entire capital works program of this year, so we are aware that there are things that are not happening, or there's just isn't the capacity in the market to do that. So we actually had forecast our total spend on our capex to go down. The impact on depreciation meant that rates would come down, and the long-term interest rates are actually starting to come down. So the net result of that is that our total cost of borrowings forecast for next year was going to come down. So those two components meant that the average rates increase dropped to 12.4. So the starting position was 12.4, and then we had the robust discussion on the better off funding, as well as the uplift in depreciation on the three waters, and that brought us down to 8.1. There were a number of requests throughout our conversation at the workshop. You actually requested a number of things to be brought back to the table, and we've brought that back in this workshop. So one of the things that we heard is you actually wanted to see the P&L. You wanted to understand what were our different revenue sources, and we talk a lot about rates revenue and a bit about fees and charges, but there are a number of other revenue items. So you wanted to see that. And you wanted to see what were the categories of our expenditure. So we've brought that back, and we'll take you through that. There is definitely a sense around the table that you wanted a better understanding of how do we actually calculate what we need in terms of rates every year, and how do we calculate what is our debt requirement year on year. So we've got some slides that steps you through the process by which we determine what we need in rates and debt. The Chief Executive was requested to identify any staff vacancies that could potentially not be filled next year without impacting on core council services. And you asked for the detail on the capital works program for 2022-23 and beyond. So we heard from you that you wanted to see the detail. You wanted to know any decisions that were made regarding this year's CapEx, next year's CapEx, what did it mean for the out years? So as part of the pack that was sent, you've all got we've opened up the books, and you've got the minute detail of our CapEx project, all the projects. So, and we'll get to that a little bit later, as I'm sure there'll be some questions on that. So this is the stage of the day where so you've asked for a lot of information, so now we're going to present that back to you. And then the next step we'll then land on, so where are we at with the 8.1%? Okay, so you asked, this is a busy slide, I'm sorry. So effectively you asked to see the P&L. So the P&L is the old descriptor for what's called the Comprehensive Statement of Revenue and Expense. It basically sets out council's total revenue and council's total expenditure. So I'll take you through this. Ask as many questions as you want, but this is seeing this will really help your understanding of how we actually calculate our rates revenue. So we have a number of council. So I'm starting at the top. and I'll go through at a pace that if I'm going too fast, just stop me. But we have a number of different revenue streams. This council is mainly reliant on rates revenue. It's our biggest income stream. It does vary, but we're sitting around 75% of our revenue actually comes through to rates. So as a council, we're highly dependent on our rates. So top of the list is our rates revenue. So this slide is showing a number of things. It's showing the current annual plan, or the current financial year that we're in, is 22-23. It shows you that we've got $83.6 million of rates revenue planned for this year. It's also got our draft, what's in the budget for next year. So 83.6 goes up to 90.9. So we've got an uplift of rates revenue requirement of $7.3 million. The LTP had us sitting at $92 million, so we're a little bit lower. We're a bit lower than the LTP. Now, the LTP, interestingly enough, the question that I expect you to ask me is, well, next year, Mark, you're forecasting your rates revenue to be lower than what's in the LTP, but your average rates increase is higher. Why? And it's because of growth. So the LTP assumed that growth would be 1.3%. So we're lower than revenue, but our growth is forecast to be 0.6%. So the rates revenue will always go up. So this will be clearer. Every year, your rates revenue requirement will go up, and that's a percentage, but the headline number is net of growth. And what's hurting us is our growth is not in line with our expectations. It's half of what we expect it to be. So then I talk to you about fees and charges. So this is where people. It's a user pay system. So our community is paying for stuff that directly benefits them. So this ranges from swimming pool fees to our building consent fees, and there's a whole range. So our fees and user charges schedule is, gosh, I think it's about 10 pages long. So there's hundreds of fees and charges, and you get to go through that on another session. But you can see the current financial year, $11.8 million. So our fees and charges adds up to 11.8, and we're now forecasting that to be $12.7 million, so an uplift of 855. So that's a combination of increasing them by inflation of 4.2%, plus some additional changes, which Paula will take you through later. So when you look at it like that, so if you make that $12.7 million higher, you can reduce your rates revenue. If you make it lower, you've got to balance out the books. And one of the ways of doing that is to make your rates higher. So it's still that balancing act. Then we get grants and subsidies. So that's mainly Waka Kotahi. That's mainly for they subsidise 51% of our roading program. There's small rats and mice come through the door as well, but it's mainly Waka Kotahi. And so that makes up, so that's both for, so it's mainly for CapEx, but we do get grants for OpEx as well. But that makes up 16.8 million, and it's now dropped to 12.8, which we can talk you through. So we're Waka Kotahi have withdrawn some of their funding, and there's works that we aren't going to be doing, and so that directly impacts on the subsidies that they, if we're doing less work, they've got less money to give us. We're doing less work, so unfortunately that goes down, and what that does is that impacts our rates revenue requirements. So all the other funding sources outside of rates will impact on our rates revenue requirement.
Sorry, I've got a question around the Waka Kotahi funding. Is that projected revenue from Waka Kotahi, or have we got it in our pocket? Because all that is up for grabs at the moment, isn't it, with the repurposing of funding to cyclone relief? How is that impacting on us in terms of the annual plan?
So I guess it's not in the bank as such, but it's locked in terms of the process that they use to guarantee our funding. So at the moment, I'm not aware of any conversations about tapping into existing commitments for council's funding, and so that's the subsidised money that they provide to us. what they have been talking about is, I guess, the government's program, Waka Kotahi's program of works, where they do have the flexibility to actually take that money and redirect it somewhere else. So once we lock in our funding bid through the regional land transport plan, it's then committed through the National Land Transport Program, which links to the National Land Transport Fund. So there's a number of documents that lock it in, so for 3 years, and next year is the last year of that guarantee in terms of funding. That funding isn't at risk. The area where it potentially is going to be an issue is in the next 3 years. So the LTP, if you like, which we go through for transport with Waka Kotahi, there's likely to be a lot of pressure on that, I guess, in terms of the capital program that the country will need to be funding, and what that might mean for a lot of local projects that are currently sitting in that. So we have a 6-year plan, and then we get 3 years of funding locked in by the government through the process. So the next 3 years of our plan and the country's plan, I expect, will be under a lot of pressure to secure funding through that process. So that's work yet to come through the Regional Transport Committee process.
So in terms of the annual plan, it's kind of outside of it, but just while we're on this, are we doing any kind of preparatory work to start prioritising and deferring projects? Like, for instance, any projects that are planned in the shorter term that we could potentially reallocate funding for projects that are further down the track but still a high priority? I'm not sure if that's quite clear. Is that clear?
So I think so. I think so. We can't take any of the money that we have at the moment and then push it out into future years. Is that part of that conversation? With
Yeah.
no, if at the end of the 3-year cycle, so at the end of next financial year, anything we haven't spent that relates to NZTA's subsidy, we can't keep that money. The process that we go through to secure funding, they have basically a minimum fixed amount that you're entitled to, which relates to your maintenance activities. And historically, the government has said, right, anything that relates to operations and maintenance, that goes through a separate process where you're almost given a guarantee that you will get that. The area where there's a focus in terms of mediation and you're not always guaranteed funding is in the capital renewals and upgrade areas. So last time round, I think we got about 45% of our minor improvement budget, which is the capital money that goes towards pedestrian refuges, safety upgrades, those improvements. So the government cut back a significant amount of that funding, but we got pretty much all of what we wanted for operations and maintenance. There was a small reduction there, but the big area where they took money out across the whole country was that low risk, low cost area. So I expect that will likely continue as a minimum, and then projects like the Link Road and other upgraded new projects for the country will also be subject to, I expect, a lot of pressure around getting any sort of funding from Waka Kotahi because of everything that's going on to recover from the cyclone.
Okay, thanks for that. I guess more information we can wait for in the preparation for the long-term plan and further briefings. Jocelyn?
Yeah, thank you. So just following up on that, I know previously when that 3-yearly cycle occurs that they're not particularly well aligned with our long-term plan process. Are they looking at improving that? So or not? So it's a case of where we could put projects into the long-term plan, hoping they're going to be funded, but at the end of the day, they may not be.
That's correct, Councillor. Yeah, so that's exactly what happened last time.
Yep.
So the Waka Kotahi board meets in August to lock in the funding for the country. By then, everybody's already locked in their LTPs. Last time round, what they have been trying to do, they sent us a letter early on to give us an indication. I mean, early on, it was actually in May, I think, or June. It was earlier than the final approval, but by then it was too late for us to do any changes. They basically indicated that they weren't going to be funding a large portion of that low risk, low cost, and I expect, and that was off the back of the last 15 years of asking them to try and align their timetable with local government. So I expect we'll see something similar as part of the next round of funding, that we'll get a early-ish, hopefully earlier than that, indication as to what that might look like in terms of the difference.
Thank you.
Yeah, good point. It's not for want of asking, but little improvement in that. Lawrence?
Darren, do you want to say
Or
something?
Darren, do you want to chip in?
Mine's a probably similar question to Jocelyn's. So I would assume that means that when it comes to us doing our long-term plan and annual plan beyond this one, we're going to have to look at that figure and say there's going to be a decrease. Is the likely expectation. Would that be fair?
Yes, I think, not sure if we've discussed it at council, but it's likely to be putting more pressure on councils to fund more of that low risk, low cost safety improvement type work without a subsidy. So if you want to continue to deliver on a lot of that work area, which is a critical one, then it's highly likely that the capital funding would need to come from the council, because that would be the basis. I think when we're into that process, I would be coming back and we'd be looking at, well, that might mean another $1 million of capex funded by council, and knowing that we won't get subsidy on it, just to keep moving with some of that work.
Darren? Something to add?
Yeah, it is. Yeah, or borrowing, depending on what reforms look like. So, thanks, Your Worship. Just on the back of those comments, we would have seen recently Waka Kotahi coming out and making statements about rescoping some of their big projects in relation to state highways, as the government asks them to look at how they can shift focus into recovery as a result of Cyclone Gabrielle. Recently at the Regional Land Transport, Waka Kotahi again pressed upon us I guess the importance that the Minister has put upon them to look at rescoping and reprioritising, which has actually pushed out some of their planning. They're about to release a recent document that's been delayed because they are having to look at refocus, and this really is just the start. You hear the Finance Minister pushing out numbers around that $13 to $17 billion in requirements for rebuild. So it's a wicked problem, and it's something that we will be probably a consequence of, like a lot of local governments around the country. So for us to be cognizant of when we do look into the next long-term plan.
Sophie?
Just a quick question as to how the 2.23 million from central government for Te Urahi fits into that figure around grants and subsidies, and whether we've already had to give that money back, or whether there's been able to be conversations around how it might be able to be used in a different way to meet the outcomes. I'm presuming probably the latter hasn't been the case, and that we've just had to give it straight back. But does that also, for example, those applications that we make in that way, that fits into that line as well?
Through you, Madam Chair. So the 2.2 would have been sitting in that line a few years ago when it came in. So it's not part of that number. And just in terms of where we're at with determining what's happening with that grant, I think we're still on that journey.
Yeah, so we certainly wouldn't have to get back 2.2, but we're currently looking at keeping, I guess, what was committed to in terms of project costs to date, but certainly not being able to draw down the remainder of that funding. So, but yeah, it's the costs to date where we're looking at trying to secure the funding that's been provided.
Kim?
Yeah, I was just looking at all this. Now, I'm not to say that this hasn't been done already, but there's two ways to increase your bottom line: increase revenue, decrease expenses. If you go through all these projects, I mean, you can take 2 million from here, put it here, but at the end of the day, it is what it is. And we don't want to increase rates. And I suppose what I'm asking, and I know there's been discussions about CCOs and all that stuff, but in my head, you just increase revenue. And so is there a dedicated plan to look at the council going into some kind of, are we actually building towards doing that? Because I don't see how we can keep putting the burden on the ratepayers and not actually be earning income ourselves. I mean, that in a simple context, that's a no-brainer, but do we have a strategy to start really looking at that? Because I know there's CCOs being floated and the Housing, the Economic Development Board, but, you know, every business out there has to make money. And if I look, I just had a quick look at our own accounts at Ngāhapa, and our dependence on grants is only at about 40%, and our services is about 50%. So I'm just, I suppose that's the question.
So through you, Madam Chair. Look, we're constantly looking at ways to reduce the burden on our ratepayers. We'd love to have a CCO that generated millions and millions and millions. You know, we'd love to. So we're looking at those opportunities, every opportunity we can to keep our costs. As part of the long-term plan, we determine what are the strategic outcomes, what is it we're trying to achieve, what are the levels of service, and that comes at a cost. So every single year, which is why we do annual plans, because we actually get to look at our cost structure. Look, there's this council actually budgets prudently, so the Local Government Act does require us to be prudent, and we're not a profit-making entity, so we have to have what's called a balanced budget. So it's very, very easy. We could forecast, we could put in the numbers that our growth is 2%. We could put 15 million of fees and charges, knowing that we're never going to get it. But the downstream risk of that is people don't use our facilities. And what we do is we start to dig a really big hole in terms of debt. In terms of, are we looking at ways, so the financial strategy that has been in the past was actually looking at closing the non-funded depreciation gap, and then to rate for surpluses, so we could actually accelerate our debt repayment by reducing our debt. We don't have those interest costs. So the Three Waters reform will provide us with an opportunity. We should be getting millions and millions and millions of dollars. And so the council, as they start to develop the strategy for the next long-term plan, the question is, what do we do with that? So Standard & Poor's, our credit rating agency, has just assumed that we pay off our debt. I think DIA have got a different formula at the moment. We aren't going to get whatever that number is, we aren't going to get that on the 30th of June 2024, unfortunately. It's going to be phased over 5 years, so that's the current thinking. But there are opportunities. We haven't yet identified a CCO that's going to yield $20 million, but we are looking. Of course, we're looking. We don't have a pool. Unfortunately, we don't have. We're not as fortunate as other councils that have got large investment funds or ports or lots of CCOs that generate income. But this is a start. We are looking at that, absolutely.
So that's a good question in terms of kind of cost savings and that general kind of annual planning. But I think what Kim's asking is a more kind of strategic question, and we could certainly be keeping that in mind as we frame our strategic vision, how we want to operate as a council and how we look at the way that we approach revenue and costs. So I think that's an important question, but maybe bigger than an annual plan discussion. Darren, do you have anything to add?
Thank you, Worship. Again, a really good question, and Mark touched on some of the ins and outs and issues that we as local government face in the litigious world. It'd be great to own a port, whether sea or air, to generate streams of income, or a forestry block, or even a lines company, which would return something to us through CCO, which would take the burden off rates. And so part of the visioning that we have started to do with you is to understand not just what our community would like to see, but also how we as an organisation are able to support the desires of our community and reduce that burden on rates. And again, Mark was quite right in suggesting that we could have exorbitant fees and charges and no one would come to see us. So for us, we need to reimagine ourselves. Part of the focus for the future for local government was about reimagining not just local government but local governance, and how the central government recognises the importance of what we do, and that focuses around localism and local voice, which is really important. So what is the mechanism for us other than through Local Government New Zealand to lobby government for a more equal seat at that table? So those are the challenges for us, and look, coming out of that Future for Local Government review, there could be some real opportunities with localism, looking at what's social aspects and what do we provide if, and this is a big if the water reform certainly changes or if goes away. But for now, we work to what is currently legislated, and that is to 1 July 24.
Kim, did you want to close off that loop before we move on to Liz? Yeah. So we've got Kim next.
Yes, so I just wanted to clarify, that's exactly what I meant. I mean, I know the staff work hard and they're looking at these opportunities all the time, but I'm just thinking of that forward thinking, and it is outside of this, but I'm just looking and thinking that's what we probably need to be looking for too. But yeah, definitely know that the staff is doing everything they can to sort that.
Thanks, Kim. Liz?
Yeah, just following on that theme, one thing that crossed my mind as Kim was talking was, are we fully utilising the assets that we have? I understand we have 849 or something pieces of land. We have Raumati Pool, which is sitting there not being used. It could do with a bit of tarting up. We could get some rental income from that. Are we actually, fully exploring revenue opportunities from the assets that we have currently?
Who's that a question for? Mike, maybe?
Thank you, Council. I think the short answer is we could definitely leverage or sweat our existing assets more than we do at the moment. We're actually coming to the subcommittee this afternoon to talk about the first of our asset classes in my area, which is public toilets. So the issue being public toilets. Everyone sniggers about public toilets, but actually they're a really important part of our infrastructure. And if you have a bad experience, it really kind of can undermine our reputation. So to answer your question, we can do better. Someone asked me about Aotearoa Park before. I think that before we add in new assets, it's really important that we're getting the most out of our existing assets and looking after those. And the series of asset management plans that we have coming to you starting this afternoon is an effort to do exactly that, to make sure we're looking after our existing stuff before we add new stuff. If we don't, then we risk having a similar experience to the rest of the country with Three Waters, not Kapiti, but around the country in other places there were no renewals in Three Waters, and the result now is a very high profile political juggernaut. So we're really hot on that, and we will be speaking with you on, I think, 8 different occasions throughout this year about our asset management plans and how we can get better out of our existing assets before we rush off and build or buy new ones.
Darren, did you have something to add?
Thank you. Maybe just to add to Mike's comments, and again, it comes back to the competitive aspect. As a council, we have to be mindful of the commercial interests that exist in our communities and how we support those sectors rather than competing against, because we can be a good demon or a really bad demon, I guess, depending on the lens that you look at us through. Chris brought a really good picture to us recently about those land holdings, and so for us there's an opportunity to do a really deep stock take and do some, I guess, critical analysis of what we hold, what they're classified as, and what is best purpose for those pieces of land, and part of that visioning again out to 2050 and beyond will help paint the picture to what reimagining local government for us really looks like. So but it's a really good question, and I mean, as private citizens, we are always looking at what we own, what we need, and how we can continue to fund that, and there's no different to what we do. So thanks for the question.
Yeah, just before I move on to the next comment, it's our assets to not primarily profit-making facilities. So we've got a push from other councillors. Councillor Wilson has been talking to staff about actually reducing fees and charges on some of our public facilities to make access to those more equitable and affordable for people. So while it's a good idea to look at extra revenue, it's also really important to bear in mind, you know, how do we want to position ourselves in terms of that balance between user pays and subsidising costs to make a experience of our assets equitable for our community. Did you want to close off that loop before we move on, Liz, or are we happy to move on?
No, I'm happy to move on. Yep.
Who's next? Nigel.
Just a couple of things, one of which is we constantly lament the fact that we have no assets, but then we don't do anything about getting some. And I wonder, in the housing space in particular, there have been a lot of people who have made a fortune off the back of the Kapiti Coast current residents by developing homes for new ones, and I'm at somewhat of a loss to understand why we aren't in that space. It's been an area where it's been incredibly hard to lose money. I know people tend to be risk averse about councils getting into that private sector space, etc. But I do think that's a conversation that this council should have had and should have, particularly around social housing, of course. I mean, you have to be a special kind of genius to lose money in that market. Anyway.
So is the next one a different point? Because I'll respond to that.
Yeah.
So we do have what's up until now been called our affordable housing entity, which we're setting up. We had a briefing on that maybe a week or two ago. So that's a work in progress. And up until now, it's been called an affordable housing entity. But what we heard from the model in Queenstown is they've shifted to a wider range of housing. So that's certainly something that we could look at through that work.
Yeah, that's a really exciting model, and I think that's, if we want to build an asset base, it's one way of doing it. The other question is, you will be aware that the current Hutt City CEO, Joe Miller, is saying without Three Waters reform, the city couldn't deal with tackling the backlog of the work needed. So basically, Hutt City is at the point where the CEO is putting their hands up and saying, without this reform, we're screwed. Words to that effect. We're heading in that direction ourselves, and lots of councils are. So, what is the contingency if I know Sean's shaking his head, going, no, we're in great nick, but really, I don't think we are, or it's at least a contestable viewpoint. So what is the contingency if that doesn't happen for us? But particularly in terms of managing debt, because at the moment we pay about $144,000 a week in interest, and that's a really good case scenario, as Mark has pointed out, and it's probably not going to get better than that. So, so what is the contingency if that doesn't happen?
Sean. Oh, Darren. They're fighting over the answer to that question.
I'm not sure in terms of Hutt City how they've got themselves into their current situation, but one of the issues that has been a problem over the years is being the lack of investment in renewals, and Mike touched on it briefly, and when we get to the CapEx work program, you'll see those expenditure lines are split between renewals and upgrades. Renewals is basically maintaining your levels of service and investing in your assets to make sure that they're not failing, and you're not sweating those assets to the point where they fail. So certainly Wellington City, I know a number of years ago, took a large sum of money from their renewals budgets. Porirua have also come out, I think, publicly and said they have got some real significant issues there in terms of that lack of historical investment. That has not been a focus for this council. historically renewals have always been an area where the council have maintained the level of expenditure that was required to keep those assets fit for purpose, meeting their levels of service. And the LTP that we have at the moment reflects that in terms of the continued investment in those assets. So in terms of a contingency, the rates numbers that you see projected in the LTP are based around continuing, and I'm talking on Three Waters infrastructure. We have other areas of cost as well, but in that Three Waters space, that's the contingency is to stick to that plan, and that was developed on the back of conversations around affordability, meeting minimum levels of service, making sure you've got your renewals right. And Mike has again mentioned those asset areas have asset management plans, and they set out the condition of those assets, the useful life of those assets, and the risks around not maintaining those levels of investment. So, I mean, we don't have a separate contingency plan other than continue to do the right thing, which is historically what this council has done. If that answers that question. In terms of the affordability one and the debt conversation, maybe that's something Mark might want to...
We're about to get to a slide on debt, so can we maybe park that. Hang on, Martin, could you just press your button in? Okay.
Yeah. I wonder, in light of all of that, and in light of Porirua situation, Wellington City situation, Hutt City, etc., that we shouldn't be sending an unequivocal message about Three Waters, because so far the message has come from a lot of councils, including this one. It's kind of been a little bit all over the place. We haven't said, yeah, go for it. There's been some bowing to the pressure of the say no to Three Waters people. A significant portion of their argument, I would say, is based on a racist
Nigel,
motive.
could I just ask you to park that, because we're trying to get through an annual plan briefing. I do think that's a really good point.
Well,
but
it's huge though, isn't it?
It
Because
is
Three
really
Waters
big.
But
It's too big for today.
makes
I
a
think,
massive difference
is what I'm
compared to Three
saying.
Waters out. That's all.
Yeah, and I think we have sent a message that we're kind of philosophical about the fact that it's out of our control, that we want to make sure that we're no worse off, but we acknowledge that other councils are in a lot of difficulty. I don't think that's all over the place. I think that's quite a clear message. It's not up to us to decide whether it will or will not happen. But yeah, if we want to change our messaging on that, that's a conversation that we really need to have. We've already made 2 submissions on the topic, and I've spoken to the select committee about it on the first submission. So, yes, so if we wanted to change that messaging at this point, then that's a discussion we need to have, but outside of the conversation today, I think. Martin?
I wasn't going to talk about anything about it, but I'll quickly say I'm pretty happy with the messaging we've sent to government on our proposals, which have been pretty strong. We didn't join up with that other group for reasons to be at the table to influence rather than throwing stones. Yeah. Sorry, look, my question's more of a clarity thing, to be honest. Look, there's talks around, looking at ways to generate revenue and as such. Just some clarity from my end. Before you even have that conversation, you've got to know what you've got. And just, I'm under the impression over the last few years that we've been going through a process of doing a stock take of our land holdings, stock take of our buildings. We've put a maintenance program in place that wasn't there before. So we've done a lot of work over the last few years. And I'm saying this, I guess, for the other councillors as well, with regards to getting an understanding of where we stand as a council from an asset base. And would I assume from that a lot of that work should have been done by now, and that will we start to perhaps have those conversations as to what next? And that's part of the questions around the CCO, about the CLT, all that sort of scenario there as well. Would that be a fair comment?
Yes.
Yes, yes.
Yeah, it's a really good comment, and if we take ourselves back to when we set this long-term plan, that was part of the focus in looking at CCO and if it is fit for purpose for our council. So those are really, really good points that you raised, Martin, and thanks for tabling them.
And going back a few years too, we did a comprehensive facilities review, I don't know, some years ago, which has been regularly updated. Can't remember how many years ago now. It was 3 councils ago, I think.
Yeah, because I know we took a hit with regards to...
It's ongoing.
Obviously, the Waikanae Library being closed down. We had a Warts and All report come back around that, which a lot of that was taken on board. And obviously the community centre was part of that equation with the black mould and that sort of stuff there as well. So my view is that we'll be starting to, especially coming to the next long-term plan, be looking at those questions around what are we going to do with the assets we have. And I appreciate, Mike, your approach has been regards to let's use what we've got rather than create new things as well. But it's good to have that understanding of what we do have as we move forward.
Yeah, I think what I'm hearing from today is we're keen as a council to have a detailed understanding of the state and maximising the efficiency of our, and potentially the profitability of our assets, and also having a look at what's happened before with a view to doing the best we can with what we have.
I just think for clarity from
and
my
also looking at
perspective,
opportunities.
I'm not worried about profitability from our assets because from my opinion is as a local council, the issue is we are supplying community service, so we're not profit driven. I think that's really, really important to understand. My personal view is that we need to be getting additional funds out of central government, the taxation side of things. It's just not a fair split. And what we're hearing about other councils like Lower Hutt, etc., is quite frankly the current equation does not work. It's pretty much all maxed out as such. So I've been pretty clear on that one, and I certainly think that's what we should be pushing as we move forward.
Thanks, Martin. I think we'll move on to the next slide now. I'm not seeing any lights.
Thank you, Madam Chair.
Or
So
continue with this one.
we'll continue with this one. Look, wonderful discussion. We'll just bring it back to what we're trying to show you is just our different funding sources and expense items. So development and financial contributions. So definitely outside of the scope for today's discussion is our development contributions. They are very, very technical. Generally what we do is we review our DC policy as part of the long-term plan. There have been some changes where we may need to do that earlier, but it's very highly specialised and not for deep dives today. Development contributions are basically at the highest level as it's developers' contributions to infrastructure as a result of growth. You can see that we don't actually generate mind-blowing numbers in terms of our DCs. This year's annual plan is 3.9 and next year is 2.07. It's based on, obviously we have a good idea of the development that's happening in our district, what's on stream, what's not, the likely timing. So we predict when those development contributions are actually payable. But not large sums of money, but that's external funding. Developers do actually get charged for infrastructure as a result of growth. So it's just another revenue stream that we have. And then other operating revenue. So generally speaking, this is mainly vested assets. So when developers do development, the roads and the infrastructure of that development get gifted, in inverted commas, they get gifted to council. And then we then have those assets, and then we then maintain those assets, which is why you have developer contributions as well. So very, very large numbers there, because included in that is the vesting of old State Highway 1 sections. So we were anticipating $51.8 million, which was the old State Highway 1. I think it's Mackay's Crossing to Peka Peka. We've anticipated it coming. Being vested to us earlier, but until such time as we're happy with the condition of it and all the agreed works have been done, we certainly won't take those assets. So we're not anticipating getting 51. And the accountants, it's an asset that comes through, it's recognised as revenue because it's an asset, and then it depreciates. It's not actual revenue, this is non-cash. We do not get, unfortunately, Waka Kotahi do not give us $51 million of cash for the asset. We just take ownership of that asset. And in terms of the draft annual plan numbers, that $38 million is the same asset. It just reflects the timing of sections of those assets being gifted to the council. So you often hear me saying we're a $150 million organisation, because we are. Our revenue, obviously the vested assets, State Highway 1 vesting of those assets does give us quite an artificial boost. But this year we're a $168 million organisation, and in terms of revenue, and we're forecasting to be 157, bearing in mind some of that is actually, old State Highway 1 assets. So those are our main revenue streams. So rates, fees and charges, grants, subsidies, development financial contributions and other operating revenue. That makes up the whole gamut of our revenue. And then we've got our expenses. So we've got personnel costs. So those personnel costs there include, so it's staff salaries, training, recruitment, KiwiSaver, the whole lot. So that all goes into the mix of personnel costs. We then have maintenance. So we have to maintain our assets, make sure that they are actually, some of them get broken and get damaged. So we have to maintain those. We have to fix things. Things get vandalised. It's not capital spend. It's just actually maintenance, because sometimes they break down, and we've got to make sure that they keep going. So we've got $29 million worth of maintenance. So we do substantial maintenance across the district. Professional services. So these are specialist services. For example, we have our legal fees. We have consultants advising us on a number of things, but they're specialist services, what we call our professional services. We have other operating expenses, and this does vary. It's pretty much the catch-all for everything that's not in those categories. So, for example, well, it's certainly not $6 million, but the advertising costs. It's graphic design costs for our statutory documents. It's staff training outside of what's in personnel. So it's a whole lot of things. It's conferences, it's travel, it's all sorts of stuff. Then we get the net interest expense. So as you know, in terms of our treasury management, we do pre-funding. So we put large sums of money on term deposit that generates interest income. But we then have debt that we have to pay interest on, so that offset the two, that gives our net expenditure. And as Councillor Wilson has identified, it's $7.4 million going up to $8.9 million. So every time we draw down debt, that adds to our interest costs. And then we have what we've spent quite a bit of time on this morning is our depreciation. So there's the $3.3 million uplift going from 25 to 29. So our total expenses. Current year is 108. Next year we're forecasting 117, which means an operating surplus of 39.8. And we do what we put in the annual report. We go and we put it in the performance report. So that's not cash. That's actually just the result of the valuation of the assets that are gifted to us. So we pretty much have a balanced budget. But when you have old State Highway 1 assets being gifted to you, you can't balance it. You can't take $39 million out of your rates revenue because it's not cash. We have to find $117 million worth of cash because the depreciation is actually going into our asset renewals. So getting into the building blocks of the rates revenue, how do we do it? So the first thing we do is we flip it on its head, and we go, right, we've got an LTP, we've got a strategy, we've got activities, we've got a level of service, we've committed to all these deliverables. What is that going to cost us? And so the first thing we do is we work out what are our costs. So around about September, October every year, we start looking at the budgets. We work right through the organisation. We start to ask the questions, what is it that we need to do next year? What is all the new stuff that's come through the door that we haven't planned for? What is it going to cost us to deliver on what we said we're going to do? Effectively, that's what we do. And so we work through all the budgets, and it's the same categories. Have we got the right level of resourcing? Have we budgeted accordingly? What maintenance are we doing? What is our CapEx program? How much new debt do we need? What impact is that going to have? What's happening in the market? Where are interest rates going? What do we think our net interest costs are going to be? What additional outside, external professional services do we need? What is the depreciation going to be? So we're doing our CapEx forecasting. What are we actually going to finish this year? What's the depreciation in next year? And what are all the other operating costs? So, and a lot of that is also, new cost pressures that are coming through the door. So we calculate what are our total operating costs. So what's the total OPEX to this organisation? And we're saying it's going to be 113 million, so 8.3 million on current year. And then we say, right, okay, that's what it's going to cost us. What else is coming through the door in terms of revenue? So the first thing we do is we work out our fees and charges, and we say, right, let's deduct that. So total operating costs, that's going to be part funded by fees and charges. What are the capital and operating grants that are coming through the door? So we would take operating grants out straight away. What is the other operating revenue? So we're literally looking at our operating costs. So we're taking operating revenue streams out. And then, as we've said, we've been given the green light by yourselves to reallocate $3.1 million of federal funding against OPEX. So we've taken 3.1 out. So total expenses, total operating expenses, less other operating revenue is what we do. And what falls out of the bottom, so we've the total deduction, so there's $22 million. So we need $113 million of operating costs. Less, we've got $22 million coming through the door through other revenue for OPEX, and so that leaves $90.9 million, and that effectively right there is your rates revenue requirement. That's how it works. It's a mathematical formula. What are your costs? What are your other revenue streams? And the balance is rates.
What I'm going to do is get through the annual rates building box slides, so there's 2 more, and then I'll take questions.
So this is an important slide. Thank you, Your Worship. This is an important slide as there's generally speaking, there's a little bit of a misunderstanding. So you've seen the 2 numbers. So at the moment, we're saying that the rates revenue for requirement for next year is $90.9 million. The current rates revenue requirement for this financial year is $83.6 million. So if you do the variance between the two, it's an 8.7% increase, right? So we will rate for $90.9 million. That's what's going to go through the system. That's what we need in terms of cash to be able to pay all the bills. So we've got $22 million of cash coming through from other funding sources, and we need $90.9 million. So that will go through the system, and that is the size. Some people call it a pie. Some people call it a cake. It's the size of the cake. So the rates revenue requirement is the size of the cake. So it's just got 8.7% bigger than last year's pie or cake. But then we have what we call a headline rates number, rates increase, which isn't a headline rates increase at all. We say, what is our growth? And we think our growth right now is, right now, what we're seeing on the ground, developments and the increase in our rating units for next year is 0.6%. So we've got 22,500 residential rating units, and we're saying that that growth is 0.6%, which means that the rates increase after growth is 8.1%. So that's our headline. It's our headline. The average rates increase is 8.1%, and every council is doing exactly the same. They are reporting their rates increase after growth. So essentially what that means, it's not an average rates increase. It's an increase relative to the rates revenue last year, less growth. And so what we do get year on year, we do get, when the rates invoices go out, we do get a number of concerned residents ringing up and saying, well, you said it was 8.1%, but I'm at 13%. Because the rating system is a blunt tool, and our rate system's got land value, capital value, and fixed charges. So it really depends on the characteristics of the individual property as to how they'll be impacted. But we all take if you approve $90.9 million, that goes into the rates tool, and it spits out how much is in land value, how much is in capital value. It's a rate in the dollar land value, it's a rate in the dollar capital value. We've got multipliers called differentials, which is why we have what's called an online rates tool, where you can actually put in your address and it calculates what your rates increase is going to be, because it's using your property, that property's characteristics. And also, so the council has what we call it's called our rates policy, but in terms of local government speak, we call it the funding impact statement rating policy. And in that, it just sets out what our rates are, how we charge it, what the differentials are. But we also have at the back of that, we have a number of examples where by ward, rural, commercial, residential, it sets out basically what, so for example, in Parapara Umu, a list of properties of different values, what will be their rates increase so people can see. But we do have an online rates tool calculator which gives specific detail. So lastly, you also asked us to explain to you how do you determine how much debt you need year on year. So this is a little bit simpler. So first of all, we actually work through our capital works program. What assets are we going to do? So officers work through that in painstaking detail, and you have it in front of you. And we come up with a number. So the capital works program is going to cost 88.7 million. That number can change. Doesn't matter what it is. It's the same formula. So we say, right, it's $88.7 million. And just like we do with rates, we go, well, what money is coming in the door to pay for our capital works programs? The first thing we do is we deduct the external capital subsidies that we're getting from Waka Kotahi and any other subsidies that we might be getting from central government that are specific to our assets, our capital works program. So we take that off straight away because we don't need to draw down debt for money that we're getting for our capital works program. We've then got rates funded depreciation. So of that $29 million, as you know, we don't fully fund our rates, but we do rate fund some of it. So the rates, the depreciation that we're funding by rates is being used to renew our assets. So a main funding source of our capital works program is rates. So we take that off because we're not going to double dip. We're not going to charge ratepayers for it and then borrow money. We don't do that. And then the astronomical amount that we get from development contributions of 2.1 million. So again, what is it going to cost us? What other funding sources are we getting for our capital works program? And so what falls out is the balancing number, and that's what we then plan to debt fund, $53.7 million. And a lot of effort goes into the timing of that. So as a basic rule of thumb, we would say, well, we're not going to draw down $53.7 million on day one. That gives us a very clear line of sight of how much debt do we need for the financial year. But we work with our asset managers, our activity managers throughout the year. We do forecasts, so we know that we'll pull that money down just in time when we need it. So if projects aren't happening, we don't draw down the debt, which is why we bring to the table our forecast. But that's how we effectively work out how much we need in debt and rates.
Thanks, Mark. Before, there's an article and stuff saying Kapiti Coast District Council charges astronomical development contributions. I would like to point out that comment was made tongue-in-cheek and with a certain sense of irony. So it's probably going to help if we go back a couple of slides because both of the questions, I think, were on that slide. And we've got Liz first.
Okay, right. I'm going to look at this slide here from the point of view of a personal budget, which is my background, and I've spent a lot of time working with people over the years talking about how to make the best use of their income and to sort of divide things up into buckets and to take a top-down approach to managing income to make sure you spend it on the things that really matter. And it's the same for businesses too. So, for example, when it comes to personal budgeting, I tell people to just set a limit for what they're going to spend on certain categories of things. And then once that money runs out, well, tough bickies, because you're managing the amount of income that you've got and you're deciding proactively where it goes rather than overspending and then having to go into debt to fund the difference. So what would happen, for example, if we said, okay, this year our budget for professional services is 6 million, it's not 7 point whatever. What would happen if we said that our other operating expenses was now 5 million, not 6 point something, and we worked to that budget? and like I'm just posing the question. I'm not saying that's what we should do, but I just I'm wanting to go back to our community and say we've taken a really good hard look at how we do things, and this is not a business as usual budget. We've actually made some choices and decided to take some frugality measures in some areas to reflect the environment that we're in currently. And I just, I mean, I've been asking you about staff costs and all that sort of thing. I mean, I just want to be able to go back to our community, hand on heart, and say, we've taken a really good look at all our operating expenses, and we are gonna tighten our belt on a few things, and I guess to reflect the fact that that's what our community is having to do. There are a lot of people struggling out there at the moment, and I guess, having been in business myself for a very, very long time, I've always run things in a very frugal way. I come into this environment here, I don't get that feeling of that same feeling of frugality, and I get the feeling that if we want to do print a whole lot of very glossy publications to spread the word about certain things, that we'll just do that, and we'll have the graphic designers and the marketing people and the whatever else, and it's like, wow, if I had budgets like that when I was in business, wouldn't that have been great? So I just don't get that sense that we are getting by with the, an attention to cost. It's more about, well, we'll just do what we need to do, and the cost is what it is. And that might be a bit harsh. It's just a perception that I have. So why do we not set a limit for some of those things that are kind of at the frilly end, the non-essential end, and say, that's our budget for this year?
I think what you're suggesting is, because we have set a budget, you're suggesting just reducing the budget. So I'll go to Darren.
Yeah, rather than cost plus,
Thanks. Can we go back to slide 10? Just going to touch on your frugal point. So this is... Yeah, of course.
But, I'm sure there's a lot of people out there that have perceptions along those lines.
Yep.
How do we go out hand on heart and say that actually we are being very frugal?
Yep. So this is year 3 that we're talking about of a 3-year financial plan, and it started for us at 7.9%, which was a figure that was agreed by council. So the slide that you've got in front of you, if we weren't being frugal, would take us to 14%. And so what we've managed to do quite quickly, and I'm quite proud of the work that the team have done, is bring that back to 8.1, which is 0.2% higher than where we said we would be starting year 3 of a long-term plan cycle. If I was at 14%, I'd be sitting here and wondering why I'm sitting here. So I look around at some of our neighbours, and we have to compare apples with apples. We are sitting at single figures in a time where inflation is running at about 7.2, 7.3. If we go back 12, 18 months ago, that was around less than 2%. So we've seen some massive change in a short period of time. And at the same time, we are expected to continue to deliver services. If I saw salary increases of above 5%, I'd also be very concerned. This most recent salary round, if I understand correctly, we sat around that 3 to 4%. Now that puts pressure on us to retain staff, because I can go to central government and get another $25,000, $30,000. In some cases, if you change your role dramatically at the same level, up to $100,000 more in central government. I can continue to work from here in Kapiti, and I can do a couple of 3 days a week in Wellington. And so that is another pressure that we face. So the reality for us is, how do we balance off working to a a 3-year plan where we have some preconceived understanding or acknowledgements in our mind where our start point is, which for me was 7.9, not 5% or 0%, and maintaining that line and having confidence in what we bring to you, that is a really good picture. And we've really thought outside the box. You know, at 12.4, we had to understand how we could get lower. And so we went back to Crown Infrastructure and looked at what we were able to do with the Better Off Fund. And we've been able to come back to you with what I think is really sound and frugal. If we then start to look at where we save the points, a percent for us of rate is around $800,000 in its most simplistic sense. So our budget sits at around $150 million. So we start to look at the margins. If it is to that level of detail that we're starting to get to, now's a really important time to signal that you want me to go away and start to look at those margins, because we need to land this no later than June for us to be able to strike a rate which allows us to collect income so that we keep the business operating without having to dip into our back pocket. So I guess the summary there is that I'm holding to 7.9 because that was the instruction that I have in our strategic long-term plan. If that presents a level of uncomfortableness for our councillors, then there's a really good opportunity for us to talk through that today and figure out what the margins might look like, understanding that when you get to margins, you put more effort in to get less return on that effort that you put into the business. So that's probably a good steer there.
Yeah.
Look, I don't have any discomfort at all with the 7.9 or the 8.1. That's not uncomfortable to me at all. It's just a question of how we fund that. That's where I'm coming from. So, and you know, we've got more discussion to have around that. So, you know, what we're seeing there in terms of that reduction is not a reduction in the cost. It's what we're looking at there is what the jiggery pokery we've done in order to fund that gap. So that's my issue: is how do we fund the 8.1? So because you know if we look at you know what's being suggested there, that is we are dependent on Three Waters going ahead in order for that strategy to work. And then if we switch CapEx funding to OpEx, I'm presuming that we're either funding that CapEx then through debt, or we're not doing the CapEx, we're cutting back on CapEx. So there are those follow-up implications. So, you know, your first line of defence, the safest way to cope with that gap is to bring expenses, look at your expenses and bring those into line first, and then look at other things that have some risk attached to them or some other negative outcomes attached to them. So that's really why I'm querying the expense side and saying, you know, how do we go about setting our budgets for some of those non-essential expenses? Is it last year plus X%, or is it top down saying actually we're going to limit our expenses in this area to this amount and work within that? You know, what's a reasonable number to spend on those areas, just like you do for your personal budget?
There's a few points in there. Who wants to start? Do you want a response to that? I just think there's a couple of corrections that need to be made. The Three Waters funding, that's whether or not Three Waters goes ahead, that's been committed, as I understand, so there isn't a risk there.
We have to still talk about.
So I was just dealing with that one though, and I'd just like to make that really clear that there isn't a level of uncertainty around that. I'm correcting that.
Yeah, but
okay.
Yes, okay, that's fine. But that's a one-off.
Yeah, it is a one-off, but that's a different point to saying that it's actually uncertain and it might not happen and that rates might go up. I just want to reassure
Okay, sure.
around the
Okay.
table that it is
That's fine.
certain and,
Yep,
and we're not going to suddenly get a rates increase if it falls over or anything like that. So I can't remember what was the next point.
About
How
how
we-
you set budgets for those kind of non-essential areas.
Yeah.
Whether it's last year plus X% or whether it's, let's find a number that's reasonable that we budget within.
Darren, do you want to do that? Yep.
And Mark will correct me. So normally when you look at your year on year, you add CPI. You know, that's probably a fair indicator. And you adjust that also to your numbers if you have growth in numbers or reductions in numbers. So that probably is the most simplistic approach. It would be like us at home. If we're planning to go on holiday, we look at what that's going to cost and then figure out how we budget or plan for that. If we don't have enough to go to, let's just say Europe, we might cut that back and go to Australia for a holiday, and that's just using the personal approach. So for us, if we have a budget of X amount of dollars for that year, we look at what the training market looks like, how we make savings. Instead of sending people to trainings, we might bring a trainer in-house and look to bundle packages or look to work with our neighbours to see how we can get a better delivery for the dollar that we spend in that component of the business. So I'm sure Mark might correct me on a couple of things.
I think that's quite a good analogy. Was there anything else you wanted a response to?
Well, I'm not sure that entirely answers my question, but
So I'm understanding the question as being, how do we set a lower target and instruct staff to deliver existing services within a lower budget?
well, I'm not. But I'm talking about non-essential. kind
So
of
we're
spending.
asking whether staff can identify any non-essential expenses across the board.
All I'm
I
saying
don't
is
understand
like,
what's non-essential.
Well, if you, let's take the example of producing glossy reports, so.
Yeah, you've used that example. So which
Yes,
reports
I mean,
would
I'm
you
just
not want to
using that
do?
as a-
You know?
Look, I'm just using that as an example.
Okay.
It's about, if you shave 10% off what you spent in some of those areas, that's a reasonably decent chunk of money. If you take professional services and other operating expenses, you've got close to 14 million that you're spending in that area. If you took 10% off of that, that's 1.4 million. But all I'm saying is there, because I know, look, managing a business is no different really than managing personal money, and I've done both extensively. You can spend unlimited amounts on just about anything if you want to. So what you spend this year doesn't need to be last year plus X%. You can just pick a number and say, that's our budget for this year, and work within that. So what I'm saying is, for those other items, is that an approach that's used? Is there any room to squeeze a bit more out, if you like, out of the cost line? So I'm just raising it as a question. I'm not saying that's what we should be doing, it's not meant as a criticism or whatever. It's just how it's approached.
So, through you, Madam Chair, look, there's a couple of things that I'll say, and I won't say, but, obviously at the end of the day, what I said in the opening address was, it's the 16th of March and we need to either confirm the rates increase or set very clear direction of what we need to go away and do. In terms of I will comment on the glossy documents because
I don't want to pick
but
on that.
what I wanted to say
is
is look, we are relatively confident that there's no non-essential budget in our operating budgets in terms of, and the glossy reports is a really good example. So if we went back 4 years, what we used to do, and I'm going to talk to the annual report So that's a glossy document. The LTP is a glossy document, and they cost a lot of money, no question about that. And in the past, we used to print annual reports for every single staff member. We used to flood our libraries and our customer service centres with copies that people can come in. So we've scaled that right back. We've had a really good look at that. So staff don't get annual reports. It's actually finance gets one copy, each exec gets one copy, councillors get a copy. It's been scaled right back. We used to have boxes of the things. So we've taken a good hard look at what we print. So it was a really good point to raise, because in the past there was budget provision for many of the documents. We try and use local. Our graphic design spend is nowhere near other councils. So we are prudent where we can be, and when we start looking at our budgets in sort of September or October, we ask those same questions. We ask the same questions. We're all looking at our budgets all the time. But there is a need to balance, because we do need to engage with our community in a way that works with them. And sometimes a glossy document resonates better than a black and white A4. And we tread really carefully. And
I don't want to make a big
that's
thing out of glossy documents. Don't get me wrong.
so the other thing I'll point out, so the operating expenditure, sorry, it kind of slipped my mind, I don't know, but a large amount of that budget is actually our energy costs. So we have fundamental, significantly high energy costs for our buildings, for our treatment plants, and we're locked into a contract. So a lot of that goes there. We will get to it, but slide number 20 actually says that our uncontrollable non-discretionary cost increases are 8.9%, and we landed on 8.1. And I've put this slide on the table. We know that CPI is a different basket of goods. We know that we're a unique business. Our basket of goods is much more expensive than household goods. And if you look at the bill inflation numbers, yes, we've inflated our costs because we have to, because the reality is everything's going up. Our capital costs are going up 30%. And if you take that inflation out, that, in my opinion, that inflation is really low. We're actually going backwards before we go forwards. Those 5.1, 3.5, 4.2, inflation is way above that. And wait till the next bill report. It'll be right up there, 8, 9, 10%. So you can take a budget and you can scale it back to 10%, but we'll go further backwards. And how do we balance the difference? Through debt. And interest costs on debt are going up. So we have inflated, and we had a long debate around the SLT table. Should we inflate? That's a debate that we have every year as a team. You know, are our costs genuinely going up? And a large amount of our OPEX costs are going up by terms and conditions of contracts, and the inflation indices are more than that. So if you cut back without context, $2 million, $3 million, we will go backwards. We'll still have those costs, and the only thing that's available to us, the only tool that we can draw on to balance the budgets, will be debt.
I almost don't want to say glossy documents again, but I just want to say I think I'm really glad that we covered that off, because I think it's a really good example of, we can have the perception that there's a whole lot of glossy documents out there, but in actual fact it's something that staff have been really working hard on to be frugal about. So perception's one thing, but reality is sometimes another. And so I wonder if we could just maybe over time, as we approach the long-term plan, get a few more examples of where we are, achieving savings within our organisation, so we can share those examples with our community, because I think people do have a bit of an impression sometimes that council is one big spend-a-thon.
Yeah, that's right.
And it's actually not the reality. Our staff work really hard to operate within existing budgets, but I think it's a really important point to raise. So something that we can, I think, we're getting the message again that people are pretty happy with the rates increase for this annual plan as it is, so that we can move forward. But as we go through our strategic visioning, we might want to think, how much is this going to cost the organisation to do this piece of work? Is it a priority for us? So that we can start to maybe achieve some real savings by prioritising what we want to achieve over time. So, but I think it's been a really good discussion. So I'm glad that you brought it up.
Well,
And I think we also, when we come back, sorry, I just want to add one more thing. When we come back with the financial strategy, we asked for a briefing on that. So potentially we can have a look at how we budget and create our operating program through our budgeting as well, because I think I've heard that a few times, that there's a feeling like it's maybe a bit back to front. Maybe we need to set the amount first and then cut our cloth to fit, so to speak. But it's a little bit more complicated than that, how we do it, and I don't know if there's room to change how we do it. But let's look at that when we do that briefing with the financial strategy and work on that towards the next long-term plan. Is that good? Does that sound like a good way forward?
Yeah, absolutely. I just want to say that I think, when we come to talk about the comms on this whole thing, I think we need to say something in there that we have actually debated around this table about, the operating costs, and we've come to a conclusion on that. So I think drawing out these kind of examples is a really good thing. So, I wouldn't want comms to go out without us having asked the questions that I've just asked and being able to say that we've asked those questions, if you know what I mean.
Yeah, absolutely.
Because the community will be wanting us to ask those things on their behalf.
Yep.
And I think to have a reason to answer to that question that we put out in the comms is a really good idea.
Yep, I totally agree. Who's next?
Oh, sorry.
Nigel? Oh, now he's down the bottom. Martin? Sorry, Nigel.
Actually, it works quite well, because I did want to dovetail a little bit onto that. I hear what Liz is saying. I've called that fiscal tension. One of the problems we've got is, as a reference point, what our community understands with regards to how they do their finances and how council do their finances are quite different. And there's a big loss in translation there, as such. I don't think we're going to get this resolved in any way for this annual plan, but I certainly would like to flag quite heavily that I think we need to have a very robust discussion around this, not as part of a briefing, but as a part of an open discussion like this, so that we can throw some things around and have some conversations in that space. The reason I point that out is because over the last 3 years, we've had a compounded rates increase of over 25%, in 3 years. So we've gone from 60 million to a rates increase of 90 million, if you like, and that's significant. Now, I understand all the reasons why, but I hark back to that point of that we know rates are a very blunt tool, and there needs to be some changes in that regard. So if we need to be lobbying government or something like that, I don't know what the answer is, but I'd really appreciate some good, strong conversations in that, because it took me quite a while as a councillor to get my head around this as a new councillor. And I dare say there's people sitting here that are potentially struggling with this as to the whys, because it's all this information's vast as such, and it's not until you really get on the other side of it yet start to understand it as such. I had a specific question though, and which I'm curious about, is that I had a 15% rates increase last year. Okay, I'm not complaining, it is what it is, but it did say it was going to be about 8%. Okay, now I've got no problem with that, but what I don't understand is that we had QV valuations come through, and I appreciate that rates are a blunt tool, but QV valuations should have shaken that out with regards to how that spread across the district, and that was done around 2021-22 financial year. Okay, so last year that sort of should have happened. So I should have been I would have thought about around the 8% mark. I was quite surprised to get it at 15%. Actually, something just triggered in my mind there. Is that to do with regional rates? Or, because I know their rate increase was substantially higher than ours, and I think that's something that's slipping under the radar here that we should really keep an eye on as well, because we're going to say this figure here from our perspective, but we know it's going to be higher for a lot of people because of regional rates. And we won't get into what potentially Three Waters is going to be asking us to do further on down the track. Yeah, and so I was quite surprised at that variation.
So through you, Madam Chair. Look, thank you, Councillor. So look, without knowing the precise nature of your property, so number one, district-wide revaluations are done every 3 years. We will put a stake in the ground in August this year, being August 2023, and Quotable Value will do the district-wide revaluations, and they will take effect from 1 July 2024. The misperceptions in the community is that they are done by council to increase rates. That is not correct. They are actually done by the Valuer General under different legislation. They are done independently. Every single property owner has the opportunity to object, and our requirement with Quotable Value is the objection period is made longer than the statutory norm. The general rule of thumb is if your property valuation is higher than the average valuation, then you will pay more rates. If it's lower, you'll pay less, but it all comes back to the size of the cake or the size of the pie that you as councillors set. So if you make it $90 million, that's what goes through the rating system. The specific reason why your rates were high, without seeing the numbers, it'll probably, yes, the rates bill includes regional council. Regional council, I think, were, please don't quote me, but they were definitely double digits. I think it was 12%. But 12% off a much lower base. They don't put $90 million of rates. They don't extract $90 million of rates out of Kapiti. It's far lower. But yes, that will come into it. But what it will be, it will pertain to the community facility rate, which is a fixed charge, which went up astronomically for community facilities, the Waikanae Library and all other things. It went from about $600 to about $880. So it's a fixed charge. So regardless of the value of your property, whether you've got a $2 million property or a $200,000 property, you're still paying $880. So that all depends on what you do and what rate it is. So it's a fixed charge. So as you know, we try and have a rating system where it's a third, a third, a third. It's a third capital value, it's a third land value, and it's a third fixed charge. If you're investing in community facilities, it swings. And I think in one of the sessions we've put on the slides, I think the fixed charge has actually gone to about 40%. So without seeing the exact your rates bill, it would have been largely driven by that fixed charge, and that's why we do review the rating system every 3 years, because we have said that Kapiti Coast District Council at times has a regressive rating system. But it also depends on what you want to do. So if we're building new community halls and libraries and new swimming pools and refurbishing old swimming pools, that goes into a fixed charge. It's a community facilities rate.
Okay. Cool.
Thanks, Martin. Lawrence?
I just want to follow through and put my thoughts around the figure that we're landed on. Because Madam Mayor, you made a comment about where we're all sitting in terms of comfortability with the 8.1 as it currently sits. I'm not happy with 8.1, but I understand how we've got to that figure and the pressures that exist that have created that figure. I think I would like to see that lower, but I get why it's sitting at 8.1 and the challenges that sit around that. And I think our challenge is going to be communicating why that is to our community in a way that they understand. Kim and I were just talking about the fact that, and like like Martin said, often how we do our things at home is very different to how council does theirs. And I jokingly said that often our community doesn't do theirs at home anyway. So there's this mismatch of understanding around finances. And I think we have a massive challenge around that communication on why this is, and it's not about a money grab, and that we are super aware of the fact that there is a lot of financial pressure in our communities at the moment, and that's just my thoughts.
Thanks, Lawrence. Jocelyn?
Thank you. So I suppose just going back to what Liz was saying, we're talking about glossy documents. I think if you look over time, no, this isn't.
Maybe we need to have a briefing on glossy documents.
Council efficiencies. If you look over time, you know, as councillors and as elected members, we used to get lots and lots of hard copies. That is now finished. Plus, there was a delivery cost associated with that as well.
I remember those days too, Jocelyn.
Yeah, so
the weekly parcel.
Yeah, so you know there have been changes over time. Then I suppose too, when it comes to us doing our personal finances versus doing them for a district, you know, in a household, you know, you have your own priorities, and you can actually, if you do them for your own personal needs and wants. When you're actually dealing with them a district, everyone has, you know, you're actually trying to accommodate a whole district, and you're not going to suit everyone. And it's about finding that balance between spending and not spending and everything else as well. So it is actually very difficult.
Yeah.
There's that. But I suppose, you know, when you look at these operating expenses, so there's, you know, you've got personnel, you've got professional services, and then you've got the other operating areas. And I'm just asking these questions not because I am aware of any particular things in there, but I suppose it's about ensuring that all the efficiencies in each of those areas have been looked at really carefully. And I suppose one of the things too that I'm aware that was done maybe 2 years ago now was the independent organisation review, which actually had a lot of recommendations which I know have not been implemented. And I think some of those were around, I think maybe efficiencies, but also morale, which actually does lend into staff performances and, you know, how effective people are. You make some comments on that?
Yeah, thanks, Jocelyn. I don't want to have a conversation about the independent review right now.
Yeah,
but I'll go
flagging
back
it.
and have a look at it. I know that at some stage we asked to stop staff from reporting against it because a few years had passed by and a lot of time and energy was spent doing that, when a lot of it should have been reported against real measures rather than against the independent review. So maybe it's time to have a wee look at it, make sure that everything's covered off from there, and that we're not dropping any balls. So yeah, I'll go away and have a look at that. I think that other point that you made about juggling the needs of so many different groups, organisations and individuals in our community is hugely challenging, and I think that's something that should be picked up in our comms as well.
Yeah. So the other thing too, in terms of those professional services, I assume it's contractors, it's also things like you know, legal costs. Sorry, my voice. And, you know, whether or not, and so, you know, how those are broken down, and, you know, like we've talked about a lot of transparency and openness, and whether, for example, those Information Act requests or some of the, you know, the TER stuff that happens out in our environment is caused by things that are actually happening within council, and if they were actually changed slightly more, they wouldn't happen. I don't know.
So, like, how to do things better to reduce the frequency of OIAs? Is that what you're kind
Yeah,
of saying?
it's about being, you know, ensuring that openness and is there, and transparency, and making information, you know, more available. I don't know.
Well, I actually think that's quite a complex question.
Oh yeah, I know it
and
is. I don't expect an answer now, but I'm just
I think we'll put that in a parking lot,
Yeah.
unless you've got something very brief you want to. Yep.
So through you, Madam Chair. Look, I just wanted to point out something that maybe hasn't quite been recognised on the other operating expenses. So we talked about efficiencies and non-essential services. So the budget for other operating expenses has actually gone down. The budget for
Yeah.
professional services has actually gone down. Well, it's gone down. So what hasn't gone down is what we've spoken to you about. Depreciation has gone up for the reasons we've said. Interest expense has gone up, and the numbers are actually on the slides and on the screen. They're right there. Personnel costs have gone up for the reasons that we've said. So the costs, we've been through the costs, and the budgets have gone down.
I think that's a really good piece of comms, that whole, just what you just said, covering all those items.
Yeah, Liz is pointing out that that needs to be included in the comms that we put out. Sounds like we're wanting to put out a bit more detail and than we have previously around the pressures and the conversations that we've been having. So definitely picked up on that.
So I know previously people pick up on the legal expenses here. And do they actually come under operating, or they're under professional services? Okay. Okay, no, that's it for me. Thank you.
Jocelyn, excellent set of comments. I was just trying to get to the end of the microphones, but I've now got 3 on. But Nigel's been waiting ages, so I'm going to take Nigel, and then we're actually going to take a break after that.
I don't want to hold up anyone's coffee break.
Yeah, I'll put you in that spot. Would you prefer to wait till after the break?
Yeah.
Okay, we'll take a break. We'll come back after 10 past. Thanks.
We've got to talk about CapEx, we've got to talk about fees and charges. Are you happy that we